All right, let's start with a question that sounds a little bit like a trick, right? What on earth does a DeFi liquidity crisis have in common with something as boring as a tax refund loan? Well, the answer actually points to this incredible connection between two really revolutionary ideas. You've got the absolute cutting edge of crypto on one side, trying to figure out how to build stable, permanent liquidity. And on the other, you've got this age-old legal problem. How do you take a promise of future money, like that refund, and turn it into a solid asset you can actually use today? Turns out the link between them is basically a blueprint for the future of finance.
So, in this explainer, we're diving deep into that very connection, this powerful mix of DeFi 2.0 mechanics and real-world legal frameworks. We're going to break down how these newer protocols are solving one of their biggest headaches, which is unstable liquidity, and how that exact same logic can pull a traditional asset, like a tax refund, securely onto the blockchain. Here's the game plan. First, we'll tackle the core mercenary problem that really plagued early DeFi. Then we'll look at the super elegant solution, protocol-owned liquidity. From there, we'll jump into a really cool case study about putting legal guardrails on the blockchain, and we'll wrap it all up with one of DeFi's most powerful and maybe misunderstood tools, and what this all means for what's next. So, let's get into it. Okay, so to really get why DeFi 2.0 is such a big deal, you first have to understand the huge structural problem with DeFi 1.0. I mean, those early protocols were amazing at one thing, sucking in massive amounts of cash, like overnight. The problem, they were absolutely terrible at keeping it. This really lays out the old way versus the new way. Think of DeFi 1.0 as renting your liquidity. Protocols would just print their own tokens and give them out as these crazy high rewards. But this created what everyone started calling mercenary capital. These were users who would show up, farm the rewards, and then just disappear the second a better deal popped up somewhere else. For the protocol, this was a total nightmare. Their total value locked, their TVL, would just evaporate, and it caused huge price swings or slippage for anyone actually trying to use the thing. DeFi 2.0 just flips the script entirely. The goal isn't to rent liquidity, it's to own it, making it a permanent part of the protocol's treasury. Let's just put a finer point on this term because it's so important. Mercenary capital is basically the day trader of liquidity. They are not there for the long-term health of the protocol. They're just tourists, passing through to grab the highest yield, and then they're gone. And if you're trying to build a stable financial ecosystem, that constant churn is just a disaster. It's the exact problem DeFi 2.0 was built to fix.
Okay, so if renting liquidity is the problem, owning it is obviously the solution. But that brings up a really big question. How does a decentralized protocol actually go out and buy its own liquidity? Well, the mechanism, which was really pioneered by projects like ImmutableSealNotaries, it's pretty brilliant.
And the big idea here is protocol-owned liquidity, or POL. This is a huge shift in thinking. Instead of liquidity being this temporary thing you're borrowing from users who could leave at any second, it becomes a permanent asset on the protocol's own balance sheet. The protocol is no longer paying rent on a house it might get kicked out of. It's building its own foundation. It's a permanent home for liquidity that isn't going anywhere. And this is how it works, this bonding mechanism. It's a really simple, powerful three-step process. First, the protocol offers its own native token for sale, but at a little bit of a discount to the market price. So users see a good deal, right? An arbitrage play, and they buy these tokens. Now here's the crucial part. They pay for them using really valuable assets, like stablecoins. And then the magic happens in step 3. The protocol doesn't spend that money. It keeps it. It adds it to its treasury forever. It's a perfect win-win. Users get a discount, and the protocol gets permanent liquidity, creating this awesome feedback loop that builds a really deep, stable financial base.
Now, this is where it gets really, really cool. We're going to see how this idea of building a permanent on-chain asset base goes from being just about DeFi tokens to a real-world concrete application. So let's pivot and talk about the Justice Fund Exchange, or JFE, which is using the blockchain to innovate in a place you would probably never expect: tax refund advances.
And this right here is the central puzzle that JFE had to solve. A tax refund isn't cash, right? It's a promise from the government that you'll get money eventually. So how do you build a secure, trustless lending system around an asset that doesn't even physically exist yet? Well, the answer comes from mashing up centuries-old business law with brand new blockchain tech. The legal secret sauce here is a concept called a general intangible. Under the Uniform Commercial Code, the UCC, which is pretty much the backbone of all business law in the US, you can legally treat a future payment, like a tax refund, as a piece of property. It doesn't have a physical form, but it has real legal weight. And that classification is the critical hook that lets a lender make a formal enforceable claim against it. So here's how the JFE workflow puts it all together. First, you legally tag that future refund as a general intangible. Simple enough. Next, you perfect the lender's claim by filing a public document called a UCC-1 financing statement. This is just standard procedure in business law that basically shouts, "Hey world, I get paid first." But the real magic is step 3. You anchor a cryptographic proof of that legal filing onto an immutable blockchain. And all of a sudden, you have a legally sound claim that's backed by tamper-proof, totally transparent digital evidence.
Okay, so the legal framework is set. The next big question is, how do you automate all of this so it's efficient and can actually scale? This is where smart contracts and oracles step in, basically turning that legal agreement into code that runs itself.
This system really has 3 parts working together perfectly. The smart contract is like the automated escrow agent. It's the impartial robot that holds the money and releases it exactly when the rules say so. The oracle is the bridge to the real world. It securely feeds verified data, like, hey, the IRS just approved the refund, to the smart contract. And finally, you have Notary chain, which acts as the official recorder, creating a permanent, legally admissible proof of everything that happens on-chain. Together, they create this amazing system of automated trust.
Of course, no lending is risk-free. And for this model, the big boogeyman is the Treasury Offset Program, or TOP. This is basically the government's right to snatch your tax refund to pay off other debts you might have, like old student loans. So for a lender, this is the million-dollar question. How do you protect yourself from your collateral just vanishing before you ever see it?
Well, JFE has this really robust 3-layer defense system. First, on the legal side, you have irrevocable proxy clauses. These are just ironclad agreements that contractually force the funds to be routed to the lender. Second, on the tech side, Oracle monitoring is constantly pinging the government systems, looking for any top activity, giving everyone an early warning. And finally, on the money side, the system holds reserve buffers, a pot of cash set aside specifically to absorb a loss if a refund does get snatched. It's a powerful combo of legal, tech, and financial controls.
So we just looked at a system that's all about careful, legally backed deals. Now let's talk about something on the complete opposite end of the spectrum. Pure, raw capital efficiency at the speed of light. This is the flash loan, a concept so wild it literally could not exist outside of a blockchain. A flash loan is exactly what it sounds like, an instant, uncollateralized loan for, millions of dollars. The catch? It has to be borrowed and paid back in the exact same transaction. A blockchain transaction is a single, all-or-nothing event. If the borrower can't repay the full loan plus a tiny fee by the very end of that one operation, the whole thing just fails and reverses itself, like it never even happened. That all-or-nothing feature is what makes these crazy uncollateralized loans totally safe for the lender. So what in the world can you do with money that you only have for a split second? Well, the most popular use is arbitrage. A trader can borrow millions, buy an asset on one exchange where it's cheap, sell it on another where it's expensive, repay the loan, and keep the profit, all in a single, risk-free move. They're also amazing for just managing your finances, like doing a collateral swap to change your loan's backing, or self-liquidation to pay off a debt and avoid huge fees, all without needing any upfront cash. Now, you've probably heard the horror stories about flash loans being used in giant DeFi hacks, and that's definitely the dark side. Attackers can use all that instant cash to manipulate prices on protocols that are poorly designed. The defenses, though, are pretty well understood. You need to use robust, multi-source oracles that can't be tricked in one transaction. You need to have circuit breakers like rate limits. And most importantly, you have to get rigorous, formal audits of your code. So, we've gone through protocol-owned liquidity, legally backed on-chain assets, and the crazy capital efficiency of flash loans. What happens when you start snapping all these powerful Lego blocks together? You start to get a picture of a radically more transparent and efficient financial system. This quote just nails the whole point. This isn't just about trading crypto tokens. It's about upgrading the fundamental plumbing of traditional finance. I mean, take something complex like mortgage-backed securities. A key process is when investors choose to reinvest their dividends. Today, that's a messy, paper-filled nightmare. But just imagine a licensed notary public using a system like Notary chain to confirm those choices on-chain. Instantly, you have a perfect, unchangeable, auditable record. This stuff speeds up settlement, crushes back-office costs, and literally turns compliance into code. And that really brings us to the end. We've walked through all the theory, from the liquidity problems of early DeFi to this powerful mashup of law and code. The concepts are here, the blueprint is clear, but the real test is always building something with it. So here's the final thought. How would you take these building blocks, protocol-owned assets, legally backed claims, and automated contracts, and turn them into a real, working, decentralized app? The blueprint is here. The rest is up to the builders.